Hey everyone, in this video, I'm going to review Tractor Supply Corporation and answer if the stock is a buy after evaluating two of its major risks that it's facing right now. Of course, Tractor Supply sources a significant percentage of its products from China, and tariffs on that country are rising significantly. I'll talk about that as one of the biggest risks. And then I'll also look at valuation. I've done a proprietary discounted cash flow valuation on Tractor Supply. I'll share with you the outcome of that calculation. And I'll also look at valuation on a forward price to earnings basis to come to a conclusion on if the stock is a buy, hold, or a sell at current market prices.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right. So one of the more significant risks it's facing right now is macroeconomic and consumer demand risks. The company is an economic cyclical business. Fluctuations in the economy can lead to changes in consumer spending, which can affect demand for the types of products that Tractor Supply Corporation sells. I only highlight this because in the near term, economic growth is slowing down. I just saw the first quarter GDP numbers for the United States, and they were negative. And remember, the Bureau of Labor Statistics defines a recession as 2 consecutive quarters of negative GDP, and we already got the first quarter of negative GDP in the United States. So one more quarter of negative GDP, and they could identify the first half of 2025 as the US economy being in a recession, albeit it's a mild recession that is driven by the increase in tariffs, and it could reverse in the second half of the year if there should be major deals between the United States and its trading partners, or if President Donald Trump pauses or reduces some of the tariffs, which he's already done several times. So it's a kind of weird recession, a self inflicted recession for the United States that could be reduced or eliminated and returned to strong growth in the second half of the year because overall the US economy was strong coming into this year. Unemployment rate was at record lows, but the uncertainty as a result of the tariffs is causing huge slowdowns. And if you're fearing that your business could enter into a recession, you're not going to hire individuals, and all of that slower spending could cause people to, Tractor Supply Corporation sells various products, some of which is more habitual, some of which is more of a necessity, and some of which is discretionary, some of which you can delay. And those are the segments of its business that could experience a slowdown is that discretionary side of the business, things that are not necessities. People will pull back on those and they'll continue spending on those things that they see as necessities. All right, the next risk I'm going to highlight is related. It's the supply chain and operational challenges. So, Tractor Supply is a outsourcer of its products, meaning that the things that you see at Tractor Supply, most of it buys from other merchants. So it sources those from merchants, and most of that comes from outside of the United States. And so the tariffs on China over 145%. The last time I looked, Tractor Supply sourced anywhere between 20 to 30% of its in-store products from China. It does have a strong local distributor network, so it can offset some of the impacts from the tariffs by shifting some of the sourcing to more local producers. So it can decide and say, you know what, with the 145% tariff, most of these products that we're sourcing from China, they're not going to be competitive. People are not going to want to pay those higher prices. We just won't order those things anymore. We'll source more things from our local distributors and fill our shelves with more stuff from locally supplied sources and therefore skip the major impact of those tariffs. Sure, we might not have some products in stock, but our competitors are also not going to have those products in stock because our competitors will face those same higher tariffs. So it's not like consumers will go to a competitor store to buy the things that they can't find at Tractor Supply because Most US businesses that are importing from China will make the same decision. They'll look at it and say, well, if I was selling this product for $20 and now I have to charge my customers $45, $48 for that same product, they're probably not going to buy that product anymore. Sales of that product are likely to crash. And so it's not worth us sourcing that product, letting that product have shelf space in our store when it's not going to turn over as well as it was previously. So we'll source more from local producers, and maybe some areas of our shelves will be empty, like we saw during the COVID-19 pandemic with out of stock and empty shelves at various retailers, including Tractor Supply. All right, so now that we looked at the risk, let's look at valuation. And I conducted a proprietary discounted cash flow for Tractor Supply. And I'm not going to go through all of the steps of my valuation. If you want a detailed breakdown of how I created this discounted cash flow model, I have dozens of videos that are member exclusive videos. So if you join my channel as a member, you can watch a detailed breakdown of this discounted cash flow valuation and the similar video for dozens of other companies. But for now, I'm just going to talk about the outcome of this calculation. And that's the intrinsic value per share, which came to $41.11. The current market price is $50. So looking at it on my DCF calculation, the stock looks slightly overvalued according to this calculation. Now, I also like to look at valuation from a couple of more sources so that I get a bigger perspective on valuation. And when I measured the business on a forward price to earnings basis, which I get this data from finchat.io, the stock is trading at a forward PE of 23, which is right about the average valuation this business has traded for going back to January of 2023. It's been lower at times, as low as a forward PE of 19, and it's been higher at times, as high as a forward PE of 29. So 23 is right about the midpoint. I would say it's fairly valued according to the forward price to earnings. So in conclusion, Tractor Supply slightly overvalued on my DCF basis, fairly valued on a forward PE basis, and the business is facing significant risks to its supply chain as a result of the tariffs. So all that being included, I would say that Tractor Supply, it's a hold. If you're thinking about buying this stock, I would wait to get this stock at a better price. Something in the low 40s would be the highest I would pay for Tractor Supply amid these rising tariffs. Of course, if the tariffs are canceled and there is a deal in place, then that changes the whole calculation, and I'll have to make another video on Tractor Supply. But as it stands, Tractor Supply stock, I rate it as a hold. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.